Welcome to the Reboot Chronicles, connecting you to the world's top leaders and CEOs rebooting their organizations and themselves with revealing stories to help you prosper in unprecedented times. I'm your host, Dean DeBias, and as a serial CEO who's led dozens of companies that created thousands of jobs and billions in revenue, my passion is uncovering powerful lessons that can inspire you to reboot your organization, your career, and your life. Listen and subscribe wherever you get podcasts or at rebootchronicles.com. I'd like to welcome Pagaya's co-founder and president, Sanjiv to the Reboot Chronicles. Pagaya is an AI-powered underwriting platform connecting lending partners like Visa, MasterCard, U.S. Bank, Ally, and SoFi, and others with a network of over 130 institutional investors. Founded in Israel, taken public on the NASDAQ, Pagaya has optimized AI to underwrite what we call the second look loans, the kind of traditional lenders might decline, by partnering with financial institutions that want to expand credit without all the risk, so to speak. A billion-dollar company, actually more now, they've experienced massive growth, evaluated probably over $2 trillion in loan applications, and generated over $32 billion in credit across millions of consumers through point of sale, personal, and auto loans. That is a lot of data. With hundreds of data scientists, they continue to lead the industry, expanding AI platform capabilities that go beyond the old-fashioned FICO score systems. And they just launched a new billion-dollar POS lending program. We'll find out what that is. Sanjiv, good to see you.
Good to see you too, Dean. Thank you for having me.
Yeah, there was so much we could put in that opening. You guys are, what do we call it in our category? You guys are on fire in a good way. You've kind of came in as the later stage scale guy, like I do, and but you've been very close to the founders and known what's going on as this company has grown. What's that journey been like as they've rebooted and that whole leadership journey that got them to where they are? Can you give us a little perspective on that, and maybe a little color on what is the company really doing now?
Sure. So as you rightly mentioned, I came here about a little more than 18 months ago. The company had been public since 2020, so a couple of years as a public company. Remember, I had worked all my life in very established companies like Citigroup and Morgan Stanley and so on. And so
we call them the big dogs. You're a big dog.
The big dogs. And with the big dogs, I was either, as I think I mentioned to you before, I was either sort of working with somebody where the institution was created 200 years ago and there was some crisis going on in the economy or the company. Citigroup, I came in during the financial crisis. It was a lot of fun trying to fix something there, but the company had been built by somebody else 200 years ago. And I always wondered what it would be sort of to be a bare knuckles leader building something from ground up. And the interesting thing, if I may, when I came here 18 months ago, was that Pagaya was, even though it was public, it was still kind of a startup. And
A little public startup that got big fast.
That got big fast. And so
I think a couple of years ago, you had like almost 400% growth or something. I mean, that's phenomenal.
Incredible growth. And, there were three founders, owners. I'd never worked for a founder-owner company. I'd only worked in large banks, as I said, where they asked you to think like an owner. And here I was actually working with the owners. So I thought, let me see what it's like to actually be an owner as opposed to, or being part of the ownership as opposed to think like an owner and fake myself into it. So it's a super interesting journey because I have learned things that I felt like I'd checked all the boxes in my life as an executive. I'd been a CEO for, as I said, for big divisions of big institutions for almost 15 years at Citigroup, and then president at First Data, which was a gigantic KKR-owned company, which I took public in 2015, and then CEO of a Lone Star company, which was Caliber Home Loans, which we sold very successfully to New Residential, which used to be owned by Fortress at one point in time. So I checked the box on being CEO, and I thought I was done in my career. Until I got really, in fact, I had retired for about a year and a half. after I sold the last company. And then I thought to myself, how can it be that I let this AI wave pass by me? And how can I not understand what it's actually doing? And is the promise as real as it's made out to be? Um, so that was one thing that was going on in my head. On the other side, I also saw that banks were generally shrinking because of regulation and all the cost of capital constraints on banks and all that kind of stuff.
Right.
And private credit was stepping in as the novo bank, so to speak, like trillions of dollars coming into these large institutions. They were becoming the alternate banks. So I thought, well, Pagaya seems to be using AI and is in the middle of the banks that don't want certain kinds of assets and private credit that desperately wants those assets. And Pagaya is using AI to connect lenders on one side with funders on the other side. So this is going to be a really interesting opportunity to understand these cross currents that were going on in the industry.
Right.
So that was my sort of my macro view when I came into Pagaya, not realizing, well, the challenges were going to be I'd never worked for kind of a startup.
You didn't have three secretaries, you
I did
mean?
not have three secretaries. I had not slung my bag on my shoulder and walked to work in a long time. So this felt a little bit like my analyst days when I was starting up my career.
Yeah.
And some really interesting uh, things happened. Firstly, the founders were all young. And they were eager to learn. They'd clearly proven to the market that there was a business proposition out there, and they'd hit on something which was really intriguing. And I'll describe that in a second. They realized, they're mature enough to realize that they had built this in Israel, where the modeling capabilities are world class. But the biggest financial services market is in the US. And the whole private credit phenomenon that I talked about earlier was going on in the US. So they were spot on in picking the right market. And then they hired a senior seasoned executive and had to give him the ability to scale and institutionalize it. Uh, and it's worked out so amazingly well for me and for them, I hope. But for me, both in a professional satisfaction sense,
Yeah.
as well as in truly understanding the role of AI and private credit. Um,
I've moved. I've moved a lot of people around the world, from big companies to small. Not
yeah,
so many small to big, but
yeah,
yeah, it doesn't always work out. You've came in at the right place at the right time with the right people, which is what you need.
yes.
And obviously you've got a tiger by the tail. How are you guys managing this massive growth you've been going through? I mean, you throw in a couple acquisitions. You're not the company you were when you got there.
No, that's right. We just to put things in perspective, we now have almost $800 billion of flow that comes into our business every year. We are we've issued we issue about $8 to $10 billion of loans a year, so it's like a medium-sized lender in some ways in 4 years. Um, I'll give you an interesting analogy. Uh, I was talking to an $8 billion lender about a year ago.
Hmm.
I asked them how many underwriters they had, and they said they had 100 underwriters.
Yeah.
Guess how many underwriters we have? Zero.
10,
Zero.
0.
Right? It's all model driven. And I thought to myself,
Well, you have data scientists
we
too,
have,
though. So.
yes, we have 100 data scientists, however, right? And they look at trillions of, you know, data points that
Yeah.
come in through these $800 billion worth of applications from 31 partners. So the ability to use data to make better, smarter decisions than traditional underwriting is like proven. Now I get it. I'm seeing that the use of big data, the use of AI, and the ability to respond in milliseconds to a well founded consumer decision is truly what is going to change, in my opinion, several aspects of banking in a very positive way that I find fascinating. Uh,
Right.
and again, I'll give you more analogies as we go through, but um, managing this has been relatively short answer to your question. How do I manage this tiger by the tail, so to speak? Um, and this explosive growth is because we've built the technology and the infrastructure, and the business scales really well once you have the technology and the infrastructure, because the business is not dependent purely on scaling with human beings. It scales extremely well.
And so does this mean the old FICO score era is coming to an end? Where are we going here?
The FICO score era is long gone. Uh, uh, the FICO score,
Nobody told me.
the FICO score era, and again, I don't mean this particularly about FICO, but it's more about traditional underwriting, Dean.
Yeah, it seems like it was made up by the banks just to, in that, credit based economy. It's like how much credit do you have?
Yeah, you remember, used to be the case you went to meet your bank manager for a loan, the bank manager looked you in the eye, and then it evolved into, oh no, you could actually call a 1-800 number and you can get a loan online.
Right.
So I got all that. I sort of lived through all of that. And when I was leaving banking, uh, I realized that underwriting in a bank, the process of approving a loan was rule based. Whereas I'd say that the process of approving a loan these days is data based. And you realize that FICO and many of the credit scores were scores that were based on a certain set of static rules. Whereas now we have dynamic information that keeps coming in across 31 lenders. So even though I don't use the data from one lender to another, I use the intelligence
Yep.
from one lender to another. And I can spot trends much faster than anyone else because, for example, if I have, let's say, 10 auto lenders and I see that one lender's risk is going up, one lender's customers are not paying as quickly as the other lenders or the other 9 lenders are, I can dial down the approval rate for that lender almost instantaneously.
So you can manage his risk in advance before he even asks you to.
Totally,
It's a real time marketplace.
exactly. And then
Yeah.
I actually call the lender and I say,
Brilliant.
do you realize that you are outperforming your
Have you
cohort?
noticed your volumes going down?
Have you noticed?
Why, yes, we did.
And
Yeah.
if you haven't noticed, in about 3 months, you can expect your loan starting to go much worse than others.
Yeah.
So this ability to do that at a loan level and as well as a portfolio level is intriguing. And so I think this is the new wave of banking, new wave of
Yeah.
lending.
If I had to pull a fire alarm or kind of limit the blast radius on some of this stuff, when we were kids, they used to have layaway plans, right? You'd go into I'm going to date ourselves here, but you go into Sears and Roebuck, as they used to call it, and you could do a layaway on an item, right?
Yep.
And you actually wouldn't get it. You would just make payments for it, and then eventually you'd get the item. Now
Yeah.
the item will be obsolete by the time that happens. So now we have this instant mentality in this country and in others, even in India, this is starting to happen with peer-to-peer lending. But so two questions. This is like, are we going down the wrong track where credit is just too easy? But the real question was a point of sale decision. So if I'm checking out and I'm buying a laptop for $1,200, you literally can instantly make me an offer based on just by a couple of key pieces of information. And you can make an offer right at at retail. Is that
Yes.
how it's kind of working?
Yes. So I was going to say the layover phenomenon is now reversed. It's now buy now, pay later, as opposed to pay now, buy later. Uh,
Exact. Yeah, yeah. It was like pay now, and we might give it to you later
when you come back.
if we don't lose the item. Yeah, it's just the buy now pay later. We've had a couple of them on, a couple of your partners,
Yeah.
and it's a phenomenon that just so a lot of people are concerned about it. The other reason I brought it up, just where is the world going in terms of you know Loading up people, it's too easy to load up on debt on anything.
Yeah.
Flights, tickets. You probably do a Starbucks order if it's big enough. Three
Well,
easy payments.
uh,
Anyway,
I'll give you a couple of thoughts that we have and why we think this concept of being able to approve a loan instantaneously based on data and then based on past performance of these cohorts of loans is
yep.
actually a much better way of serving the financial system. About
Uh,
42%, Dean, of American consumers get rejected by their banks today. And guess what they do? If they don't get a personal loan from their bank, they go to a payday lender and pay 300% interest rate. What we do is we take that 42% that wouldn't have been approved by banks, and we take some portion of them and approve them, albeit it's a very small percentage of those. We approve about, let's say, 1% of the 42% that doesn't get, and that 1% represents
wow.
that
Yeah.
1% represents $8 to $9 billion a year. Think about it, right? But this
Wow.
1% would have gone to payday lenders if Pagaya hadn't enabled that loan. And what we do is we approve that loan on the basis of how consumers that represent a certain cohort, that represent a certain uh, uh, set of transactional data sets that inform us that we have data on that we can approve it instantaneously. And we end up giving credit to people that we believe are deserving. And then through the course of these cohorts, we see what percentage of them paid versus didn't pay, and we continue to improve our models. But we know that by and large, the vast majority of them pay, and that's turned out to be what we call using data and technology to collaborate with the banks and make mainstream banks, so rather Wall Street banks, more relevant to mainstream as we.
So if I'm a bank, not to get too geeky here, I can use your platform to actually rescore my current customers that I might be
Yes.
ignoring for loans. And
Yes.
so they just need to use your technology in that case. They have money. Or do they actually want to use the whole system and not go through their regular channels?
I'll give you an example. Let's say you are a deposit customer at a bank.
Yeah.
You have, I'll make it up, $5,000 with the bank. You go to the bank for a loan for $5,000. The bank will say, "Sorry, your FICO is less than 750. I won't approve you for the loan." And you say, "But I have 5,000 bucks in deposit with the bank."
And the FICO score's your problem. You invented that.
So what Pagaya does is Pagaya will take it into account that the deposit customer has $5,000 in the bank,
Yeah.
and that Pagaya will say, "I don't care about the FICO score. I care about what a customer with a $5,000 deposit and customer with these kinds of demographics, psychographics represents in terms of the probability of payment based on my historical data. And I will approve the loan, and I will approve the loan on behalf of the bank."
Ah,
So the customer will think their bank approved the loan when in fact it was Pagaya that offered the loan on behalf of the bank.
wow. What a way to hijack a industry. I mean, that's a very creative business model. So when you look back 10 years now, this company, is that what they originally started at? I mean, AI was not as developed then. Have they been through a bunch of pivots to get to where you are now?
Yes, it has. So the company started pretty much like a quant fund manager that understood quantitative, uh, that had very well developed quantitative skills, that bought assets from banks that it thought were saleable to the private market.
Mm-hmm.
Over time, as AI developed, because of the company's very strong quantitative heritage or the founders' very strong quantitative skills, they felt that instead of buying assets in bulk from a bank, they could actually approve one loan at a time using AI and using their technology that was embedded in the bank's loan approval system. So the Pagaya technology, Dean, is actually embedded in the bank's underwriting system.
Right.
So if Dean were to apply for a $5,000 loan and the bank says no, it automatically comes to Pagaya, and Pagaya's models approve it in less than 1 millisecond. Uh, and Dean gets the loan as if it is approved by the bank. And the loan is approved in the bank's name. And so we've now switched from buying loans in bulk to buying loans one loan at a time.
Yeah. At speed, at scale. Yeah. So when they started, that was back. I remember this. I was chairman of a company we were selling to Salesforce, but that was like the data scientist era.
Yes,
It's like data scientists were hard to get. We'd pay them $400K,
yes,
way too much money to come in. And then AI essentially has replaced a lot of them. So now the data scientists are working on even bigger models, of
yes,
course.
yes.
That makes a lot of sense for how you pivoted. Where do you see it all going? I've got a couple friends that have Web3 companies that are a little early. I've got others that actually have peer to peer, fintech companies. One's in India where there's a big demand for. Do you see it going peer to peer versus private, funds to people, or give us a view?
Yeah, I mean, I see it in a couple of places. So, um, uh, what I described to you was how Pagaya works with banks and with lenders.
Yeah.
I told you kind of half the story. The other half of the story is that at the same time that Pagaya approves a loan on behalf of the bank, remember I told you the loan is issued by the bank itself, although Pagaya was the model behind it. Pagaya also takes that loan off of the bank's balance sheet and immediately securitizes it through a securitization structure. So it doesn't sit on the bank's balance sheet. So I like to say the bank kept the customer, but not the asset. Uh, right.
Brilliant.
And on the other hand, you had private credit buying it. So it's a very efficient model. And it reminds me a little bit of what Jeff Bezos said about the success of Amazon. And obviously the analogy is we are not even close to that league. But Jeff Bezos said, I was able to build Amazon on the back of the fact that somebody had invented a cardboard box, that somebody else had invented, that there was the internet, that there was a very efficient FedEx delivery system. I just connected the dots and I created Amazon out of things that somebody else had created.
Yeah, same.
So
You could say the same about Uber. It wouldn't exist if we didn't have the smartphone wave. Didn't take off right then because
exactly,
you need a screen.
exactly.
By the way, the other thing Bezos doesn't get enough credit for. People thought he's crazy, but it's like, oh, I want to let small merchants sell on my platform too.
That's right. That's right.
They thought he was nuts, and
Yeah,
Walmart is still trying to catch up.
yeah,
Of course they've been on the program, of course, and doing quite well now, and everyone's jumped into the marketplace thing,
yes,
which is essentially what you've created, but in a very different way, where you're
exactly.
getting
So what
assets.
so what we've created based on, to use the same analogy, is something created by somebody else, but we connected the dots to make it more efficient. Somebody created AI and big data and all the data modeling and using all
Yeah.
of that to make consumer decisions, which we are doing in real time. Somebody creates the flow of consumers that come in through the banks themselves. And then there's private credit, which is the new data set, sort of data point, sort of, in my argument, that is the alternative asset uh, uh, creator. And so what happens is you connect the dots. You have the customers, the banks uh, wouldn't have given the loan to, that you're now able to give on behalf of the bank in real time. And you're able to take it off their balance sheet because there's a very efficient private credit market. So your question was, where does this go now? And I see this
Yep.
as um, essentially analogous to what is going on in the mortgage industry, which is an industry I come from in some sense.
Hmm.
Dean, you'll remember 15 years ago, the biggest lenders were the big four banks in mortgages.
Right.
Now the biggest lenders are Rocket Mortgage and UWM and so on and so forth. The non-banks came in.
No,
And
right.
the non-banks came in because the special sauce non-banks offered was, they said, we'll give loans to consumers that banks will not give loans to. And so And it wasn't because they were rejected by banks, it's because regulation forced the banks to shrink their credit box, or banks felt that the capital requirements of these loans on their balance sheet were too onerous, so they didn't want 30-year mortgages on their balance sheet. So that led to the emergence of non-banks. When I think about from the secured side, which is mortgages, all the way to the unsecured side, which is credit cards and personal loans, uh, they are expensive for banks to keep on their balance sheet. And banks, therefore, have a very high FICO cutoff score. And so banks really can't afford to give those loans. And so we come in sort of like non-banks. But instead of being a competitor, we are a collaborator with the banks. And we show them how they can give more loans to their deposit customers, more loans to their investment customers, and not keep the risk of those loans on their balance sheet. So
Right.
exactly fit for purpose. So where do I see this going? It's a $5.4 trillion market. Um, our market cap is a little over a billion, so we have a long way to go.
Yeah, exactly. And some of the partners that you're working with are some at a distance they almost would look like competitors. But you both have a kind of a SaaS model as well as a co-lending model. It's creative. What about peer to peer? Do you see that in the next 5 years or so to be more not for homes maybe, but for smaller exchanges?
Possibly. I think that the concept of peer-to-peer started with sort of democratizing the funding. And I think that as uh, the category becomes more reliable, as the models become more uh, dependable, that it'll go beyond private credit to peer-to-peer. Um, I would say the downside of AI is that its explanatory power is not as good because it's so complicated and there are so many things that go into it. And so, for individuals to invest in sort of the what they consider the black box, which
Right.
is its explanatory power is low, and however, its performance is high. And so my view is that as performance starts to become more stable and stable through the cycles, as you know, the economy goes through all kinds of cycles, interest rate hikes and
Oh yeah.
drops,
Yeah,
credit
people will run.
cycles.
People run for the hills in certain cycles, and but if they look at things like GoFundMe, it's almost like it's been like the prototype, the test market, and then you've got Venmo and Zelly, and all the peer to peer stuff is happening.
Yeah,
It's not mass market,
yeah,
mainstream,
yeah,
and with the disappearance of cash,
yeah.
seems like it's a perfect storm. But
Yes, that's true.
so, how about yourself? You've been through, like me, you used to be, big dog working at the big companies and made the transition to startups and all that. I bet you've got some amazing stories. But what have been some of your personal challenges you've had to work through?
Well, my biggest personal challenge was that I didn't have the appropriate uh, 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 wardrobe. Uh, so I remember I was going to Israel to meet with the tech team and the AI guys and gals and everybody else.
Oh no, you didn't wear a suit,
And
did
the
you?
founder said to me, Sanjiv, I think you'll have to dress a little younger. I'm like, what does that mean? Uh, so I went looking for the one pair of jeans I had. And uh, But I'm kidding. So the way I've positioned this now in the company is that, look, we're a fintech. Why don't you guys be the tech guys? I'll be the fin guy. I'll dress up like the fin guy.
Yeah.
Um, but it's been such an amazing transition. I feel like this is the part of the and Dean, this might sound somewhat philosophical, but for a guy who'd worked in the biggest banks in the world and who dealt with some of the biggest crises in the world, like the financial services meltdown and all that kind of stuff, the mortgage crisis, running Citibank during its the peak of the mortgage crisis, running Citibank's mortgage division during the peak of the mortgage crisis. So from there to come to an AI company, which was like there were no real rules. There was no real protocol. The shortest distance between 2 points was a straight line. It was really helpful to me that I had transitioned from the big banks through to private equity running smaller companies that prepared me for this transition. But I will admit it has been a transition. And the other big thing for me was I always felt I had been, like you said, like you, a big dog in a big company, but that big company was built by somebody else 200 years ago. And now you were, now you were basically doing everything from start to finish. And you were building the company on your own, and you were scaling this company, and you were out calling the same people that called on you 10 years ago, and they weren't returning your phone calls. So, and then you realize that at the end of the day, in these big companies, you were borrowing the brand of somebody else, and you felt it was all about you. Um, and now,
Exactly.
right, and now you realize it's truly about you, and it's truly about building something, and the ability to be able to influence change. So, for example, when we grew our market cap in the last 18 months from $700 million to $1.2 billion, the fact that we had a hand in it uh, was very important. The fact that we will take it to the fact that we've proven a value proposition and we feel good about really good about where this is going, and the fact that we can influence its market cap and create value for our shareholders and our employees, for our customers and for our customers, that's very meaningful.
Yeah. Great story, Sanjiv. Thanks for joining us today.
Okay. Thank you.
You've been listening to Sanjiv Das. This is Dean Tobias with the Reboot Chronicles. I want to thank you for joining us. Listen, subscribe wherever you get podcasts or at rebootchronicles.com.